Well, welcome to the program. Hope your day is going well. We got a lot to talk about as we do each and every week on the show. The calendar has flipped to August, which here in Florida means that it's back to school time. Now, for those of you who are listening to the show through our podcast channel and might be living up in parts north, well, then school doesn't start till September. But here in Florida, it starts in August. So this weekend, hopefully you took advantage of the tax-free savings weekend. That's where you can go to the stores and buy school supplies and clothing and footwear and even computers. And you are exempt from having to pay the sales tax. So a nice little opportunity to save a little bit of money under the principle of sort of going back to school. I frankly have been highly remiss on the program, actually not promoting something that we are doing at the office at Nelson Financial Planning. It's the first year that we have done that, but we've partnered with a gift for teaching and tools for Seminole schools, and we're doing a school supply drive. So anytime between now and September 1st, you can drop off new school supplies, even old electronics for recycling, at the office during sort of the weekday business hours. So been remiss on not sharing that with our listening audience. Our clients, of course, know that we are doing that because we sent that little attachment, a little pamphlet out with an email communication that we sent out earlier this summer. But for our listening audience, we are in fact doing a school supply, appropriately enough, school supply drive, appropriately enough, right? Going back to school. For me, 2 out of the 3 go back to college, so that's a little different of a cost than just simply going into the local store and buying some new clothes for the upcoming school year. I say 2 out of 3 because the good news is that 1 graduates. Still looking for a job, so his search continues, but 2 out of 3 going back to school. It just seems like yesterday, right? Was walking them into school, walking them into kindergarten, and now off to college. And I guess that's life, right? It goes quick and things change. And certainly the same can be said for the economy and the markets, right? Different periods of time produce sort of different things that ultimately drive the market. And we think that there are 2 sort of chief differentiators that are percolating out there in the background that are going to be big drivers of what's going to be leading going forward. And these are themes that we've certainly been talking about for weeks, probably months now on the program. One of which, of course, is cost of capital. And what that means is that when you have higher interest rates, then capital, i.e. money, winds up costing more when you want to use it. So that means if something costs more, then generally it winds up being a little bit more selective as to where those dollars flow. We talked a little bit about that on the program last week when we were joined by fellow certified financial fiduciary at Nelson Financial Planning, Rob Field, where we talked a little bit about the cost of capital and what that meant. We're going to talk a little bit more about that this week in terms of what the implications are from an investment strategy. What are the implications? What does it mean for the markets? What does it mean for your money? How should you be investing today? And then, of course, the other theme that is running in the background is inflation, right? Last week on the program, we shared that story about the pizza delivery. I hadn't done pizza delivery for a while. It's like, for 2 pizzas, normal pizzas. And granted, I should have looked and found a coupon. Shame on me for not doing that. I'm sure they're out there, but I didn't take the time. Sometimes, we do things quick and then we don't get maybe the best possible deal. Well, I did that with pizza delivery. 2 pizzas, $50 with the tip and the delivery and blah, blah, blah. So inflation, very much real. That's clearly going to have an impact on your money as well, right? How you should be investing today is you're going to need to kind of use that template of what is sort of the differences in today's world versus the past 10 or 15 years. So with that, we welcome on in all of our listeners to the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team stands ready this week to help you improve your life with a successful and cost-effective financial plan. So past decade, we had cheap capital, right? Interest rates low. That means you could get your hands on money and it didn't cost you very much. So a lot of that money that we saw went to a particular sector of the economy that is very capital intensive, and that is technology. All those chips and supplies and the supercomputers that house all the cloud data and all of that stuff, that costs money. So ultimately, those technology companies use a lot of capital. When it's cheap, it's easy to get your hands on a lot. So what that meant for the market, particularly over the course of the past several years, and we've talked about this at length on the program in the past, but what that meant for the market is that it was pretty narrow, in that there were a small number of companies that were driving the bulk of the performance of the overall market for many, many years. The statistics that we've shared with you in the past and we'll share again is if you look at the FANG stocks, Facebook, Amazon, Apple, Netflix, Google, those 5 companies, as they are referred to as, at one point there was a 5-year period from like 2016 to 2021 where those 5 companies were driving over 30%, nearly a third of the performance of the S&P 500 companies in that index. So just 5 companies driving a third of the performance, not just for a little window of time, but for an extended time period. That's because capital was cheap, cost of capital was low, and it was flowing into technology. Going forward, starting to see maybe a little bit more of a broader market, starting to see certainly the impact of inflation on that. So where do we go for perspective? Well, we're going to be putting on our bell bottoms, going back to American Bandstand, boogieing into the 70s here on the program, where we're going to draw some comparisons and give you some statistics about just how important it is to not just own value companies, but to own companies that are actually paying a dividend. And there is a difference there. We're going to get into that on the program. And then much talk and much conversation out there about the future, the new economy, if you will, that's driven by technology and internet and data and cloud and all that stuff. But here's the thing, when you stop to think about all of that new economy stuff, you can't get to the new economy without the old economy. And interestingly, there's a couple of major pieces of legislation that have become law out of Washington that emphasize more on the old economy stuff. By the way, think highways, bridges, infrastructure. You get the idea. So at the end of the day, how does that ultimately adjust what your investing approach should be? All that coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. It is August, which means that it is back to school for folks down here in Florida. Orange County Public Schools starts August the 10th is when the kids are due back in. Hard to believe it is that time of year already. Want to take a minute and mention that we are doing a back-to-school supply drive at the office. I don't think I've really mentioned that much. We've certainly shared that with our clients over the course of the past couple of months, but I don't think I've shared it with our listing audience here on the program. So want to make sure that we invite them as well to participate in a back-to-school drive that we are doing in connection with a gift for teaching and tools for Seminole middle school. So if you'd like to donate, just stop by the office during normal business hours, 9 to 5, Monday through Friday, and we will be happy to receive your donation for that. Of course, August also means that it's 2 months left in baseball season. So we're going to take a moment and talk a little bit about sports, because we know that our friends over on 96.9 The Game, which is one of the networks that our show comes to you on, well, that's a sports channel. So we always try and every now and then throw in a little sports analogy here. And so we're going to talk a little bit about baseball, because in the dog days of summer, teams are starting to jockey for position for the playoffs with baseball. And I guess there's a lot more teams that make the playoffs in baseball now because they've expanded it. But when you're looking at the statistics, it may surprise you that the Baltimore Orioles, of all teams, are actually leading the AL East, which many people often describe as the hardest division in baseball because it's got the Yankees and the Red Sox. And don't forget the Rays. They've been on a pretty good run of late over the past few years. Well, the story on the Baltimore Orioles is that they have surprised many people in terms of how well they are doing this season, right? So at the start of the week, they were in first place in the AL East division. Consider this, between 2018 and 2021, so those 4 seasons, 3 of those 4 seasons, they lost over 100 games, which when you lose over 100 games as a Major League Baseball team, that means you're kind of not very good. But lo and behold, what has surprised everybody is that they are or were in first place as of the beginning of this week. So sort of at the end of July, first place in the AL East. And I guess that certainly underscores the unpredictability of sports. It also underscores the unpredictability of the markets, right? Entering this year, certainly the Baltimore Orioles were not picked to win the AL East. Certainly, if you think about the market predictions and the economic predictions, what was predicted to occur was that a recession was coming. Supposed to be there, supposed to occur during the year 2023. But instead, the markets have actually kind of done the opposite of what you might expect. Now, here's the caveat. I think it's way too early to call an all clear as to recession probability over the next 12 months, but certainly it is nice to see patience and consistency being rewarded for long-term investors. Because when you think about where the markets are, just in July, the Dow did a streak of 13 straight days where it was up. So 13 days in a row, the Dow actually had positive movement. That is the longest such period of time in over 35 years. So it's been a while since we've seen that kind of a strength in some of the market indexes like the Dow. Through July, the S&P 500 was up about 19% compared to down 19% for last year. So if at the end of last year you said, I've lost 19%, I'm out, I'm dumping my large company investment allocation, and I'm just, going to go to cash or sit on the sidelines or whatever the case may be. Well, yeah, as is always the case, markets are highly unpredictable, just like sports. And so lo and behold, markets up 19% through July. So it sort of speaks to that unpredictability, right? It also speaks to a changing market. And we're going to talk about those changes in this part of the program. So welcome on into Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're one of Central Florida's longest running radio programs, coming to you on a host of stations throughout the Central Florida region. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out on your favorite podcast channel of choice. When you get there, make sure you subscribe so you know when we upload new content. Any problems finding us on any of those channels? Well, go to our website, nelsonfinancialplanning.com. Upper right-hand corner, you'll see a bunch of icons, although I think one of the icons still has a bird, and we need to change that over to, I guess it's an X now for Twitter. Anyway, you get the idea. Go there, whichever icon looks most familiar, click on it. You'll get immediately directed to our channel on that particular platform. We, of course, also have a YouTube channel where you get to see me in all of my glory. You can be the judge of that. Coming to you from our fabulous Nelson Financial Planning Studios that are on site at the office. Whenever you come by the office, make sure you ask Carolyn or Jamie for a little tour of the studio so you can kind of see where the show comes from. Anyway, one of the biggest things that we've talked about is the market potentially going from sort of this narrow to broadening in terms of the types of companies that are causing the market to go up. We've certainly talked about the market being quite narrow in that it was driven by a lot of tech companies, and a lot of that is attributable to the cost of capital being very cheap, and so that does well for technology companies that have big capital expenditures or big capital requirements. So the question that we want to ask is are you still sort of stuck in that narrow allocation that's focused more on technology? Then you may want to be careful about that, because it's going to potentially cost you money. Because the current weighting on technology is much more dramatic than people realize. If you think about the Russell 1000 index, right? 43% of that, nearly half, is technology companies. You see where the market over the course of the past few years have really evolved to be quite narrow, to be quite focused on technology. Almost like if you didn't own technology, you didn't make as much money as you could have. And so as we think about capital costs increasing, one of the things that we see is that dividend-paying companies wind up ultimately generating a lot of the return when you go through periods where you have higher interest rates and higher inflation. So to get some perspective, we're going to go back to the 70s. So put your bell bottoms on, turn on your American Bandstand, maybe even watch one of those original Star Wars movies. In the 70s, I was a kid growing up in Maine, where, junk mail would actually come to your mailbox and not to your computer. What was happening in the markets was quite interesting, right? Because if you go back to the 70s, you find a higher inflation. So where was the return coming from during that decade? Well, the largest part of that return for that particular decade was, in fact, dividends. Now, dividends have always been a part of your overall investment return. If you look back over the past 100 years, dividends account for about 38% of the return over that period of time. So still make up quite a bit of it, a little bit over a third of the return that you'll get as an investor. But in the 1970s, it was 72%. Almost 3/4 of your return came from dividends. In contrast, over the course of the past decade, only about 16% of your return actually came from dividends. It came more from appreciation and things like that. So we want to stay on this dividend story, particularly because we want to make sure to draw the distinction, and this is kind of the key concept, between owning a value company, which a lot of people think are dividend-paying companies, and actually owning a company that is paying a dividend. There is a big difference to that, and we're going to talk a lot more about that on the next segment here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So we're blasting back to the 70s. So put the bell bottoms on, listen to some American Bandstand, maybe watch that old episode of one of the original Star Wars, not like the newer ones, but the original ones. And you're going to find an interesting time from an investment perspective. As we were sharing before the break, 1970s, obviously a decade that had a lot of inflation. I remember as a kid up in Maine, kind of just sitting in the back of the car, having to wait in long lines to get gas, a whole kinds of inflationary pressures that were happening during that period of time. When you look at the 70s from an investment perspective, one of the key pieces that you see is that if you had a more dividend orientation, well, then you would have actually been decently rewarded. In fact, during the decade of the 1970s, 72% of your return for that decade came by virtue of owning dividend-paying companies. So pretty dramatic in terms of the contribution that dividends make. And not just for the 70s, but throughout market history, dividends have contributed roughly about a third of the overall investment performance over time. In contrast, the past decade or so, the dividends have kind of gotten minimized. Only about 16% of the return has come from dividends. The rest of it through capital appreciation growth, which, as we talked about early in the program, directly correlated to cheap cost of capital. When you don't have to pay any money to borrow money, then you can get tremendous growth because the cost of taking those dollars and continuing to reinvest them into your business is quite low. You can sort of make some decisions that maybe you wouldn't otherwise make because it's so cheap to get money, right? If you make a mistake with the money, I can go back out and I can borrow more money at a really super cheap rate. But obviously, that's not the story now, right? Cost of capital has gone up dramatically. Interest rates up dramatically. And I guess here's where we really want to draw the distinction. So we talk a lot about growth versus value from an investment perspective. But you really got to dig a little bit deeper on what that means. Because when we think about value, not all value types of companies are created equal. When you think about value companies, think about those types of companies that would, like a Warren Buffett would typically invest in and things like that. But just because you're a value company doesn't mean you pay a dividend. And here's where the truth comes in. Here's where you've really got to pay attention to know the difference, to know the distinction, because far too often value, dividend paying sort of get lumped in together. But there's perhaps one of the biggest separations in these concepts that are taking place now. If you look at for reference purposes, if you look at sort of the Russell 1000 value index, right? So that's supposed to be 1,000 companies, all value oriented from an investment perspective. But a third of those actually don't pay a dividend. So beware of owning a portfolio where you think, you know what, Joel, I get it. Dividends, big part of the return. That's what I want to own. Be careful with that you actually own companies that pay dividends, because a lot of value companies don't actually pay that. So here's the key piece. Here's what you need to know. Know your mix. As we talk about all the time on the program, you've got to know what you own. And that means that you're taking a deeper dive on your overall investment allocation beyond just, okay, I got X percentage in stock, Y percentage in bonds, Z percentage in cash. What you actually own actually matters inside those three very, very broad categories. So take a moment and sort of check the dividend yield on that part of your portfolio that is oriented to that value side. You want to make sure that to the extent you're wanting to own dividend-paying stocks, that you do in fact own stocks that pay dividends, not just are stocks that are categorized as value and you think, oh, that must be a dividend-paying stock. No. You've got to make sure that it actually pays a dividend. So it really pays to sort of dig deeper into that allocation. So what you should be doing is looking at, okay, well, of my value types of orientation, what percentage of that is actually dividend paying companies? And the other way that you can look at it is to look at what your overall dividend yield is on your portfolio. So certainly worth it to take a moment, figure it out. At the office, we typically run sort of a detailed Morningstar report for our clients that allows them to kind of see all of those different details. We would encourage you to seek sort of that same type of information where you're really digging in, because what you actually own actually matters, particularly if you think about it in terms of where the performance was during the 1970s, when you also had a period of higher inflation and higher interest rates. So certainly something to think about. We're going to continue here on Dollars and Cents. So welcome on into the program. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks who also happen to be certified financial fiduciaries, and they stand ready this week to help you improve your life with a cost-effective and successful financial plan. So you ever buy things that are brand new and you waited in line to get it? Think of some of the visuals that we've seen over the course of the past 10 or 15 years, where you have people like literally lining up outside of stores to get the newest product that's rolling off the shelves. And oftentimes it's a technology product. And I get it. We all like new stuff. The new stuff typically will have new features, different things. But at the end of the day, sometimes the old stuff is pretty good, right? Sometimes the old stuff is relatively dependable. Certainly, I think back to the toys of my childhood growing up in Maine. And those Tonka trucks, those things were made out of like real metal. Like, they were solid. They were sturdy. You could like sit on them and, kind of like scoot yourself along with your feet on the floor. You can't really do that now because they're kind of more plasticky, right? So sometimes the old stuff a little bit more dependable, a little bit more durable than the new stuff. And so as we think about that, there's a message there for the economy as well, sort of this new versus old. When we think about sort of the new economy stuff, it's always the really cool stuff, right? The technology and the cloud and the data and all of this more technology-oriented stuff. But then, and we think about the old stuff, well, that's like a utility, that's like a power company, maybe a bridge building company, a road company. Well, that's not nearly as exciting and interesting as as some of the other things you're talking. We might be catching our attention, the artificial intelligence or something like that. The reality is, though, that all of that new stuff very much relies on infrastructure, right? And we get it. I mean, granted, we want to own the stuff that is more interesting. Nobody wants to be a boring investor. We talk about that all the time on the program, but sometimes being boring is good. Maybe owning a company that specializes in like building roads or building bridges or building telephone poles might be a good thing, because you're going to need all of this old economy stuff in order for the new economy to happen in the first place. So you may really be missing out on some potential investing opportunities if you're only focusing on kind of the new and shiny stuff, or the companies that are producing the new and shiny stuff, whereby a lot of the companies that are focused on sort of more traditional stuff, in fact, just got a pretty sizable boost out of Washington. When we think about two of the biggest pieces of legislation that have come out of Washington over the course of the past 12 months or so, the two bills, the Infrastructure Act and the Inflation Reduction Act, when you start to parse through the spend on these bills, these laws, it's pretty significant. The spend is enormous, and it continues to get bigger each and every year. For the year 2023, it's estimated that the spend is going to be about $20 billion. For the years 2025 through 2031, it's estimated that the spend is going to be $50 billion. And that's not on new technology. That's on infrastructure. So we're going to talk about what that means from an investment perspective coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So we're talking about sort of the old economy versus the new economy, despite the fact that we all kind of like new stuff, right? And that certainly has attracted our attention, whether it's artificial intelligence or the latest in cloud computing. That sort of seems like what everybody is talking about. But don't forget, you don't get to that new economy without an investment in the old one. And particularly when we think about some of the legislation that has passed in Washington over the course of the past 12 to 18 months, the amount of dollars that are sort of flowing more to the older economy side of things. And when we think about that, think telephone poles, think bridges, think roads, think tunnels, think those types of things that may not be particularly exotic, that may not be particularly exciting, like maybe AI is, although a lot of people think that that's going to be the demise of civilization. So, pick your poison, so to speak. But when we think about some of the stuff that's actually going to be necessary to generate that newer economy stuff, it's very dependent upon the old economy, particularly when you look at it in perspective to what has been going on out of Washington, particularly some of the dollars that are going to be spent on that. And that really gets to sort of the concept of, from an investment perspective, it's always good to sort of follow the money, right? Wherever the money goes, that's where you probably need to be paying attention. So if we think about capital, which we've talked about at length earlier in the program, and how much that is costing, well, then that capital is going to be a lot more selective to where it goes. Similarly, if there's a bunch of money that's being spent on more infrastructure type of things, then that's going to go to companies like a Caterpillar or General Electric or something like that, where they're more traditional in terms of what their products and services and goods are. So it's important to really think about those types of things when it comes to your investment allocation. Not get too caught up in all the new stuff, but also think about, okay, well, how's the new stuff going to get delivered, right? I mean, if everything's going to become electric, don't we need to make sure that the power grid and electricity production is maybe ramped up because everything's going to be chewing up a lot more electricity? Well, those are the kinds of things, and those are the kinds of things that we like to be thinking about at Nelson Financial Planning, because when we're constructing an investment allocation, or we're constructing an investment portfolio, or even if we're rebalancing, we certainly want to be thinking about all of those different themes and not be getting too fixated on the new and the shiny stuff. And that, I think, is the important takeaway for our listeners today is, at the end of the day, take a look at that investment mix. Make sure that it is where it needs to be. When was the last time you did that, right? When was the last time you sat down and really dug into, okay, what are the sectors that I'm invested in? What do my value companies look like? Are they paying dividends or are they not? How much of my portfolio is weighted to the technology sector? Am I still living in the 2016, 2021 era where technology was a big driver of the overall market performance? Because as we've talked about throughout the show, whether it's the Baltimore Orioles or whether it's kids growing up and no longer in kindergarten and one of them's graduating from college, at the end of the day, things change, and the drivers of what ultimately produces performance starts to change as well as you go through these different periods of time from an investment perspective. So certainly important to keep that all in mind. Of course, that's what we do as well here on the weekly program, Dollars and Cents, where we've been helping people make sense out of all of life's decisions involving their dollars since 1984, coming up on 40 years. Can you believe that? As a firm next year. So that's certainly an exciting milestone. My name, of course, is Joel Garris. I haven't been there the entire 40 years, but I've been there 25 out of the 40. So now the majority of the time. Hard to believe how quickly that time goes. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks who also happen to be certified financial fiduciaries, and they stand ready this week to help you improve your life with a successful and cost-effective financial plan. So the more things change, right, the more they ultimately drive what ultimately is going to be going on in the markets, right? So right now, we've got an era that is a higher cost of capital, higher inflation, higher interest rates. And so what that means for the market is that instead of being driven by a very narrow subset of companies, expect that to see that be more broad base, where it's not as material that you were in the technology sector like it has been in the past, but rather whether you have a good business, whether you've got a good business model, whether you're a well-run company. Those are the kinds of things that you would see as you see the market go from being driven by a very small amount of companies in the same sector to an amount of companies that are in a variety of sectors and industries. Certainly the 70s to be our guide in terms of the importance of dividends, but know that not all companies pay dividends. So make sure that you take a little bit of a deeper dive on when you're sitting down to review your investment mix, whether you're doing that yourself or whether you're doing that with your advisor. Really start to ask some important questions on what's the overall dividend yield of my portfolio? What's the exact number? And to the extent that I own value, well, that's great, but does the preponderance of those companies actually pay dividends? Because we're seeing that nearly a third of all sort of value categorized companies don't actually pay a dividend. Well, if you're looking for dividends as part of your overall investment return, then you probably want to make sure that the company actually pays a dividend. So those are some of the things that you certainly want to be thinking about as you're reviewing your investment mix. And similarly, the new economy versus the old economy. You can't get there without some of the old economy ultimately generating a tremendous amount of growth as well. Certainly, if you think about Washington, then the dollars that have sort of flowed there really do ultimately help to drive a lot of what we expect to see going forward. Some big dollars, $50 billion plus is the spend between the years 2025 and 2031 on some of this more older economy, more infrastructure-based types of companies. So some interesting numbers and some interesting developments certainly coming out of Washington. In other developments, as we've said, back to school. So we've got a school drive going on at the office, runs from now until September 1. So if you'd like to participate in that, just stop by the office. We're accepting new school supplies, old electronics for recyclings, partnering with a gift for teaching and tools for Seminole schools on a back-to-school supply drive. Also, if you go to our website, Nelson Financial Planning, you'll see our most recent blog post, which gets into sort of the debt ceiling deal that happened earlier this summer, gives you our perspective on that. Also talks about some of the key expense categories that the average American retiree experiences. So make sure you check that out. All available at our website at Nelson Financial Planning. So important to obviously get advice and a perspective on all of these issues. If you have any questions about anything we talked about on the program, or perhaps maybe what your real investment allocation is, what your breakdown is, give us a call to set up a free conversation. We certainly do our best to stay on top of all of these changes. Any of our conversations at the office are always done free of charge. So give us a call. We'll be happy to get you on the calendar for a conversation at Nelson Financial Planning. Enjoy the rest of your week.